a new educational content video. Today we will discuss very shortly, very briefly, the market structure. So what is market structure? Market structure is the most important thing in trading, in my opinion. It's the base of charting and, of course, trading or analyzing charts, whatever you want to call it. And market structure depends or can consist out of three kinds of structures. You have the uptrend, as you know, all know the whole bull trend thing, that's an uptrend. The downtrend, this is a big downtrend. And you have a period of consolidation or balance, whatever you want to call it. Basically, a time of consolidation is a place where buyers and sellers are equal to each other. This is also a very nice level, a very nice opportunity to take a trade from if it breaks to a certain level, to a certain direction. If it goes to the upside, then the retest of the balance is a good area to long from. If it goes to the downside, the retest of the lower balance is a good area to short from. Of course, with confirmation, because otherwise it could be a deviation below or above the balance. So uptrend, what you want to know. Trends or market structures are on all time frames. So you have the higher time frame, for example, the 3-day. That's the time frame I like very much. This is all hierarchical. So what that means, the higher time frame, the more important the time frame. If it goes lower, the bigger time frame is the most important. For example, if you go to a 3-day time frame and you see we are in a downtrend, but on the 6-hour time frame we are in an uptrend, it doesn't matter because the 3-day time frame is the most important because it's higher, it's older, it's longer. So, what does that mean? As you can see, we have here a uptrend. This is a low, this is a high, this is a low, this is a higher high, this is a higher low, and this is a higher high, which was also the top. But within this trend, you also have a downtrend. For example, if we go to a lower time frame, so we go to the 12-hour, for example, here, this big period of time from May till July, you could say this is a downtrend. You could also say this is consolidation, but it makes lower highs. The lows are equal. They didn't get taken out except for this one, but the lows are kind of equal. So you could also say this is just consolidation, but I would say this is a downtrend or compression type of thing. What I mean with that is that within this big uptrend on the higher time frame, there are lower time frame downtrends, and everything you want to do all the time you want to do is trend or trade the trend. That means you don't want to go against the trend. If this is a big downtrend, you don't want to start longing every time we go to a support. You want every resistance when it's in a downtrend, and for example, if you're in an uptrend, you want to long the supports. Of course, that sounds pretty basic and self-explanatory, but if you don't know that you are in an uptrend, in a big uptrend, in a downtrend, and you think, okay, this is the uptrend, but this is the downtrend. The bigger picture is the uptrend, but this small period is the downtrend, and you don't see that we are still in a lower time frame downtrend, and you want to long every time we bounce on a support or we come to a support, then of course you can get damaged pretty quickly. Same with the other side. If we are in a downtrend here, we came from an uptrend. For example, this is an important low in my opinion. As soon as we break this, it's a pretty clear sign that we are going into a downtrend. That we're breaking our market structure into a downtrend, because the higher time frame is an uptrend. As soon as we break this low, because this is a structure, higher low, higher high. As soon as we break the low, we started to go in a downtrend. Same as this, if we break an important high, I would say this one, for example, to be safe. This is an important high. If we break that, then we change structure and we go in an uptrend. And as soon as we go in an uptrend, you want to long every time, long till we change structure again. So basically, just to sum this part up, is don't go against the trend. Don't go against the trend. Look at your time frame that you are trading on, But every time, if you're trading, for example, on the 1 hour time frame, look at the 4 hour time frame. What is the market structure? What is the trend we are going to? We are going on a bigger time frame, because that's the most important. And then go to the lower time frame and then look at the structure on that time frame. Are we at a point on the lower time frame where we could see a reversal on the bigger time frame? So, for example, if we are seeing this downtrend here, this lower time frame downtrend on the bigger picture, if we're going to, for example, to the 4 hour time frame, so this is a downtrend, of course, very clear. Let's go even lower to the 1 hour time frame. Where are we? Yeah, so this is clearly a downtrend. If we zoom in like this, we have a lower high, lower high, lower high, lower high, lower high, etc. So at some point you just want to keep shorting, because the trend is still a downtrend and you don't want to buy a downtrend. You want to sell a downtrend, of course. But as you can see, if you would short this area, so this is the high, then you would have gotten stopped out. That's what I meant with always look at the higher time frame, because now you're looking at the 4 hour time frame. But as soon as you check, for example, the 6 hour time frame, you would see that we are at an area that could activate a trend reversal. So we are at a previous low. This should be a very strong level, because it already showed a very strong response every time it got hit. And from that level, you should expect some strong upside move. So, okay, to summarize, don't go against the trend. Always watch the bigger time frame. Even if you're trading a lower time frame, look at the structure that's on the big time, the higher time frame, and just always go with the trend and not against the trend. Okay, thank you very much.